Welcome back to the channel. As always, if you're copy trading, you're an absolute moron and you deserve to lose all your money. And with that out of the way, we're going to speak today about a company called Paymentus Holdings, ticker PAY. 3.5 market cap company, billion that is, trading at almost 50 times forward PE, which is certainly premium to the sector. When you look at the sector, is currently trading at about 20 times. So that is a big premium. Why is the market paying such a high multiple for this company? Well, let's look first of all at what do they do. So as you can see from the name, they provide a cloud-based bill payment technology and solutions in the US, but also internationally. Primarily, that revolves around electronic bills and payment services. So that includes credit cards, debit cards, digital wallets, and e-check. But here's what I think is the reason why I think is a pretty good time to start looking at a company like this. The sectors which normally serves are utilities, financial services, government, insurance, telecom, real estate management, education, consumer finance, healthcare, and small businesses. So all those are typically pretty defensive industries, which in the current market sentiment that we're in have been outperforming uh, the the market. So, for example, if we have a look at how the sectors have performed recently, so we can see U.S. sectors in the last month. Some sectors such as consumer discretionary down 12%, tech down 11%, communications down 6%. So many sectors, most of the sectors actually, if not all, were down in the last month. However, the ones that did outperform were mostly healthcare, utilities, consumer staples. And that is where this company is focusing, right? So when you look at, for example, the last month, many stocks and many companies out there have been struggling. We have seen names that have been down 20, 30%. This stock, on the other hand, is down just 0.5%, so it's about flat in the last month. When you compare that to the S&P 500, well, how does it compare? Let's have a look. So the S&P is down almost 6% in a month. So that means that the stock has outperformed the overall market. So, of course, that's really more about the sentiment and timing, but why do we think that this is going to continue? So again, we think that these sectors are going to be performing okay. Likely, the volatility of earnings in those companies is going to be lower, more predictable, and possibly if we see a deterioration in the macro, going to be positive as opposed to negative, right? So um, here are a few things that I think is quite interesting about them. So they operate a transaction-based pricing model where where they get paid when their clients get paid or when a client initiates a payout transaction. So the platform enables bill payments across multiple channels and payment methods. The revenue streams are quite stable because of that. They're primarily transaction fees. That's the main revenue driver on a transaction basis. But I also have a long-term strategy in terms of converting interchange fees from a cost center into a revenue center. Okay. How have they performed recently? Well, um, in terms of the last 3 months, they have been not the best. But that's why I think the um, the market is going to start turning around. These guys are competing with very established names like Fiserv, Visa, and we take a closer look at a shorter time frame, we can see that the performance paints a different picture. So they're just not far off names like Visa, and they're certainly above other more established names like PayPal and Ford. So that means that the performance out there, and this is something that's been happening recently, has been okay, considering that high growth names or large market cap names have been back in fashion over the last few weeks. So that to me signals a pretty good indication that the timing might be getting soon. I don't think it's a position I want to enter at this point, but certainly one that I might be considering to enter in a few weeks because the performance has actually been pretty good. So when we look at sales, we see continuous beat, right, all around. EBITDA beat as well. So the fundamentals overall are looking pretty strong. And in the last Q4 2024 earnings call, that showed with record Q4 revenue in a quarter, profit as well, adjusted EBITDA. And the company also raised the guidance for 2025, projecting revenues just over a billion, which is about 20% growth. In EBITDA as well, 112, 120 million, with 21% growth at midpoint. So overall, that is looking pretty interesting. The metrics as well, in terms of the KPIs, were also quite bright. So the transactions processed in a quarter were 33% up year on year, with the average revenue per transaction being up as well. And that has also been happening quite consistently quarter on quarter. The contribution profit per transaction is consistent with prior periods. So we do see the traction in terms of the scale going on for this company. But how does the management expect to continue growing? Well, at the moment, they're very much focused in winning market share in this huge TAM of non-discretionary bills, right? So again, there's a lot of competition for these guys, which is one of the main risks that I would consider for a company like this, the fact that they have to compete with, PayPal, Visa, and so on. But having said that, that market is still very, very large and provides plenty of upside for a company that executes well on the strategy. And something that I think I agree in terms of how they're going about that is that they're targeting large enterprise clients, which, as we have seen over the last few years, have been in a stronger position compared to medium and small size organizations. So that is, I think, something that's going to bode well for them. But additionally, they have new capabilities they're bringing to market to strengthen their competitive mode. In essence, they're working toward monetizing interchange fees, such as um, the transactions that they process as a revenue source rather than just a cost center. So things that have been important for analysts have been uh, steps in winning enterprise clients, right? How that contributes to their margins, uh, the conversion of this cost into revenue, the improving guidance, and how they have remained quite stable in the macro headwinds that we have seen. So, for example, 2024 was an interesting year, some ups and downs, but overall, the company, despite being relatively small back then, has continued to remain competitive, as you can see in this chart over here. So with all that, we see quite interesting growth numbers here. So for this year, revenue expected to grow at more than 20%, having achieved that good growth levels in previous year. But what's interesting is that even though it's not growing as fast as in 2024, the gross profit is growing at a faster rate. Okay, and that comes as well with growth in EPS, which is still growing at a very healthy rate. So with all that, we see as tailwinds the increasing digital adoption in bill payments. They have strong execution in onboarding new clients, and they have that stability in terms of non-discretionary bills nature. So this is a company that is going to work well if the market turns sour. Risks I mentioned already, but I think some more that we could be considering as well is lower contribution on margins with larger enterprise clients. Uh, of course, the macro uncertainty and the fact that as a tech company, they need to continuously innovate. Their competitive advantage could change very rapidly overnight. But based on what I've seen so far, I see a company that is growing quite well, faster in some respects, and achieving that scale that is gonna take place before reaching the age of maturity. There's good growth, there's good profitability, there's new clients being brought to the customer base. There's also a strong backlog. So management made some comments during the call on their confidence on meeting the guidance with new client signings. And overall, is a pretty strong business in terms of cash generation. So the company has very little debt, which in a scenario where the prospect of rate cuts becoming more and more distant would play better than other peers. So overall, um, feel quite positive about it. In terms of the price target, is at a pretty good spot versus analyst expectations. What I see quite interesting is that despite all the strong fundamentals, the analyst community don't seem too enthusiastic about it. So the majority of ratings stay at hold, despite the multiple increases that we've seen since mid 2024. So I think there's a strong possibility of earnings beat on the 6th of May, and then the analyst ratings change, profit follows through, and stock goes up. Because expectations so far point at rising sales, rising EBITDA, EBIT, EPS, and so on. So overall, quite a solid picture in terms of expectations. You can see all that as well with all the estimates for the firm. Hope you enjoyed the video. See you soon.